Welcome to our series on creative financing, where we discuss buying investment real estate using other people's money. Today, we're going to talk about your credit report, and your credit score. Most people are aware that when they apply for a loan or a mortgage, the lender is going to request a credit report. But what exactly is that? Well, actually, it's nothing more than a record of an individual's past borrowing and repayment history, and it includes information on things like late payments, collections, consumer proposals, and bankruptcies in the last 6 years. But more importantly, it's a report on your responsible use of available credit. In Canada, we have two credit reporting agencies, Equifax and TransUnion. Whenever you apply for credit, this information is sent to the credit reporting agencies. If you're applying for the first time, they start a file on you. And then any time that you obtain new credit, things like credit cards, car loans, mortgages, lines of credit, this information is sent to the credit reporting company. And they add what's called a trade line to your report. Having multiple trade lines is considered good for your credit score. And then every time that you receive a statement on one of your debts, or you make a payment, this information is sent to the credit reporting agencies. The agencies then compile all this information and generate a credit score, or FICO score as it's known. This is just a mathematical formula created by Fair Isaac and Company, and it's a number between 300 and 900. If you have no credit score, you can have no number, or you can have a reject if your number is really bad. The credit agencies consider several factors in generating this number. They consider your payment history, the amount that you owe, the length of your credit history, applications for new credit, and different types of credit. Your credit history is the most important and makes up 35% or 315 points. In it, they're looking for things like late payments, bankruptcies, collections, judgments. The amount owed is not what most people think. The amount owed is based on the percentage use of available credit, and it is worth 30% or 270 points. How long you have had your trade lines open is important as well, and that is worth 15% or 135 points. The number of new credit applications is worth 10% or 90 points. And using a variety of different types of credit is worth 10% or 90 points. And all of this gets added up to a number below 900. So let's look at the factors individually. Payment history is the most important. They're looking for things like bankruptcies, late payments, collections, judgments. And the reason they look at this is because a person with a history of paying on time and paying in full is most likely to continue to do so. Similarly, a person with a history of late payments and collections is also likely to continue to behave in the same way. Now, that said, everyone has forgotten their credit card bill on their desk, and papers get put on top, and you realize a month later that you missed the payment date. The credit agencies look at different factors when evaluating missed and late payments. The first is the time since it happened. They also look at the number of times it happens, and they look at the seriousness of the issue. If your missed payment was a year ago, or 2 years ago, or 3 years ago, or 5 years ago, it has a less and less impact on your score than if it happened last week or last month. They look at the number of times it happens. If it happens once in every 3 or 5 years, it has much less of an impact than if it's happening every 1 or 3 months. And then they look at the seriousness of the issue. Are you actually in default? Did it go to collections? These have a much more negative impact on your rating. The amount that you owe is not what most people think. The amount that you owe is relative to the amount of credit that you have or the amount that you could borrow. So the closer the balance owing is to the credit limit, the lower the score. This is why you want to keep outstanding balances to less than 60% of the available credit limit and ideally less than 30%. For example, if you have a credit card with a $2,000 limit, you should not allow the balance to go over $1,200 or 60% of $2,000 at any time. And ideally, you want to keep that balance under $600. This is why asking for an increase in your credit limit can actually help your credit score. Then they look at the length of your credit history. Time is your friend. If you've had a credit card for 20 years and pay on time and the full amount, that is going to have a positive impact on your score. Time makes it easier to establish a pattern in the use of your credit. Applications for new credit also have an impact on your score. How often do you fill in new applications? Anywhere between 4 and 6 inquiries in the last 12 months is generally considered acceptable for hard credit pulls. More than this, and it starts to have an impact on your rating. So you want to make sure that you limit the number of hard credit pulls done on your file. And finally, the different types of credit that you use has an impact on your score. A person with a blend of credit from a variety of sources will have a higher score. Lenders like a combination of revolving and installment credit. Now, installment loans are loans with regular payments that get paid off over time. They're things like your car loans, your mortgages. Revolving credit is credit that gets restored as it's paid off. Things like your credit cards and your lines of credit. So what is a good credit score? Well, generally speaking, 680 or better is considered excellent credit. If your credit sits between 620 and 679, that's considered average. Generally speaking, the lenders will start to lend to you at a score of 650 or more, and you will have no problems if your score is 680 or higher. Once you drop below that into the 580 range to 619, that's considered below average, and poor credit is below 580. Why is your credit score important? Well, your credit score is going to determine whether a lender will give you money at all. Are they willing to lend you money? Are you considered a good risk? But it's more than that. It can also affect the type of lender who will lend you money. We have A lenders, B lenders, alternate lenders, and private lenders. Who is going to lend you money? Your score will determine whether or not how far up the scale you get. It also affects your interest rate. The higher your score, the better rate you're going to get. And it's also going to affect the amount of down payment or other collateral you'll need. The higher your score, the more likely you are to get into high credit situations. So, what can you do to impact on your score? Most people think that their credit score just happens. That's not true. There are things you can do to help improve your score. First of all, review all of your existing credit accounts every 6 to 12 months. Go through them and request credit limit increases where you can. Next, on each of your credit cards, set up one automatic monthly bill. Put your internet on one. Put your cell phone on another. You set up then automatic payments of the outstanding balances. This keeps your credit cards active. Most credit card companies will cancel your card if they're not used within a 12-month period. By setting up an automatic payment, what you do is keep the card active. You do not want to pay your outstanding balance until or near the due date. Many people pay off their balances as they use the credit. What happens then is that the credit never gets reported to the credit reporting agency, and it does not help their credit at all. You want to look for and make use of installment credit offers. Even if you have the money in the bank, you want to take advantage of these offers. The no interest, no payments, or equal payment offers. You want to use them because they help your credit score. And you want to take advantage of pre-approved credit card offers, but not more than once or twice a year. And you want to try and minimize the hard pulls on your credit history. When you're applying for a mortgage, you want to use a mortgage broker. The mortgage broker has access to multiple lenders, but more importantly, the mortgage broker will do one pull on your credit and supply your credit report to all of the lenders that they deal with. Running around from bank to bank and applying for credit individually means that each one of those lenders is going to pull your credit individually. So use a mortgage broker. You also want to make sure that you do a full pull of your credit every 6 months and look for errors. Yes, errors happen. And finally, you want to sign up for some free credit monitoring services. I use BRRRR and Credit Karma. BRRRR uses Equifax in their reporting, and Credit Karma uses TransUnion. Both of those companies will send you monthly reports that highlight changes in your credit in the previous month. So in summary, make sure you pay your bills on time. You want to avoid maxing out your credit. You want to make sure that you have a variety of credit accounts and types of credit accounts. And you want to use your credit. By doing these 4 things, you will impact your credit score positively.